What if the retirement withdrawal you think is safe is actually costing you money and limiting the retirement you worked so hard to enjoy? Many Americans assume their RMD is the amount they should live on, but that's not what an RMD was designed to do. And here's the surprising part. 84% of retirees studied were taking only the minimum. Welcome to American Dream Finance. Today, we'll uncover the real mistake behind that number, how taxes and withdrawals can work together, and what you can do instead. Stay to the end because I'll give you a simple framework you can use to make smarter RMD decisions without unnecessarily shrinking your retirement. If you're retired or you're getting close to retirement, there's one number you may be paying way too much attention to: your required minimum distribution, or RMD. And here's where things get interesting. A recent JP Morgan analysis found that 84% of retirees who had reached RMD age were taking only the minimum amount required from their retirement accounts. Meanwhile, many retirees who had not reached RMD age were taking no withdrawals at all. At first, that sounds completely reasonable. After all, if the IRS says you have to withdraw a certain amount, why would you take more? But that question is actually the heart of the problem. An RMD is a tax rule. It is not a personalized retirement spending plan. That distinction matters. Your RMD tells you the minimum amount you generally have to withdraw from certain tax-deferred retirement accounts to avoid a penalty. It does not tell you how much you can safely spend, how much you should spend, or how much income you actually need. And there's another important correction to the common explanation of RMDs. The RMD age rules have changed over time. Under current law, the applicable starting age is generally 73 for people who reach age 72 after 2022 and age 73 before 2033, with the applicable age increasing to 75 for people who reach age 74 after 2032. So you should not rely on an old rule that simply says everyone starts RMDs at 73 or 75. There's also an important exception. Roth IRAs generally do not have lifetime RMDs for the original owner. Traditional IRAs and many workplace retirement plans, such as traditional 401ks, are generally subject to RMD rules. Employer plans can have additional rules, so your specific plan matters. Now let's look at why taking only the minimum can become a problem. Imagine a retired couple has $800,000 sitting in traditional retirement accounts. They also receive Social Security and have other savings. Their RMD might be relatively modest compared with their total financial resources. If they automatically treat that RMD as their entire retirement budget, they could end up making a major mistake. They may spend years protecting an account that was supposed to help fund their life. Think about what retirement is actually for. You spent decades working, you saved money, you invested, you delayed spending today so you could have more choices later. So the goal isn't simply to reach the end of your life with the largest possible retirement account. The goal is to use your money intelligently while still making sure it lasts. And there's another reason this matters. For many retirees, spending doesn't stay constant throughout retirement. The early years may involve more travel, hobbies, dining out, or visiting family. Later, spending patterns can change. So if you're extremely restrictive with spending in your 60s and 70s just because you're afraid of touching your retirement account, you could be giving up some of the years when you are healthiest and most able to enjoy that money. But, and this is important, the opposite extreme can be just as dangerous.
Taking more money simply because you can is not automatically smart either. Traditional retirement withdrawals can increase your taxable income. A larger withdrawal could affect your federal tax bill and, depending on your situation, potentially affect other income-based costs. That means the real question isn't, should I take only my RMD or take more? The better question is, how much should I withdraw based on my taxes, spending needs, other income, investment strategy, and long-term goals? That's the decision an RMD number cannot make for you. And this is why I don't think the 84% figure automatically means that 84% of retirees are making a financial mistake. Some of those people may be doing exactly the right thing. If Social Security covers most of their expenses, they have other taxable or non-taxable assets available, and keeping withdrawals low helps control taxes. Taking close to the RMD could be perfectly reasonable. The mistake happens when the RMD becomes a psychological spending limit instead of one piece of a larger retirement plan. So before you decide that your RMD is the amount you're supposed to live on, stop and look at the bigger picture. Your retirement account was built to support your life. The number the IRS requires you to withdraw is not necessarily the number you should spend. And in the next part, we'll look at how a retiree can actually build a smarter withdrawal strategy around taxes, Social Security, and their other sources of income, without simply guessing at a number. So if your RMD isn't supposed to be your entire retirement strategy, what should you do instead? The answer is not to automatically withdraw more. The answer is to create a deliberate withdrawal strategy. Let's say you're 74 years old and you have $750,000 in a traditional IRA. You also receive Social Security, and you have some money in a taxable brokerage account. Your first step shouldn't be, how much can I take out of my IRA? It should be, how much income do I actually need this year? Start with your expected annual expenses: housing, food, insurance, transportation, travel, gifts, healthcare, everything that realistically belongs in your budget. Then subtract the income you already have coming in. For example, if your household needs $70,000 a year and Social Security provides $45,000, you have a $25,000 gap to cover. That gap may be filled from your retirement accounts, taxable investments, cash savings, or a combination of them. Now here's where the RMD becomes useful. Your RMD establishes a minimum distribution requirement from the applicable retirement account. But instead of treating that number as your retirement paycheck, you can incorporate it into your overall income plan. And there's an important tax point here. Money coming out of a traditional IRA or traditional 401k is generally included in taxable income, except for amounts that may have special tax treatment. So taking substantially more than you need could create an unnecessary tax bill. But taking less than you need simply to avoid touching your retirement account can create a different problem. You're allowing the tax-deferred account to dictate your lifestyle. That's backwards. Your spending needs should help determine your withdrawal strategy, not the other way around. There's also another strategy many retirees overlook: tax diversification. Imagine you have 3 buckets: a traditional IRA, a Roth IRA, and a taxable brokerage account. These accounts don't all behave the same way for taxes. A traditional IRA generally creates taxable income when you withdraw money. Qualified Roth IRA withdrawals can generally be tax-free. A taxable brokerage account may involve capital gains, dividends, and other tax considerations. That gives you options. Instead of blindly withdrawing from one account every year, you can look at the tax consequences of different combinations. For example, suppose your RMD is $35,000, but you need $60,000 of additional cash flow. You shouldn't automatically assume the remaining $25,000 has to come from the same account. Depending on your circumstances, you might use a combination of taxable assets, Roth assets, or additional traditional IRA withdrawals. The right answer depends on your tax situation. And this is where professional planning can become extremely valuable, because the best withdrawal strategy isn't necessarily the one that minimizes this year's tax bill.
It's the strategy that makes sense across many years. Sometimes paying a little more tax today can reduce a much larger tax problem later. For example, a retiree with a large traditional IRA might eventually face increasingly large RMDs as the account grows. If the account continues growing while withdrawals remain low, future required distributions can become larger. That can create a difficult situation later in retirement. This is one reason some retirees consider taking additional withdrawals before RMDs begin, or using Roth conversion strategies during lower income years. But Roth conversions have their own tax consequences and aren't automatically right for everyone. You need to consider your tax bracket, other income, Medicare-related income thresholds, charitable giving, future RMDs, and your long-term goals. And don't forget about Social Security. Your withdrawal strategy and Social Security strategy can interact. $1 of additional taxable income isn't always just $1 of additional federal income tax. Depending on your circumstances, it can affect how much of your Social Security benefits are taxable and potentially influence other income-related costs. That's why retirement planning becomes more complicated once you have several different income sources. Here's a simple way to think about it. Your retirement income has 3 jobs. First, it needs to pay for your life. Second, it needs to manage your taxes. Third, it needs to make your money last. A good withdrawal strategy balances all 3. And there's one more mistake I want you to avoid. Don't assume that your RMD percentage is a safe spending rate. The IRS tables are designed for calculating required distributions. They were not created as a personalized retirement withdrawal formula. Your actual spending rate should reflect your age, health, portfolio, guaranteed income, expenses, tax situation, and how much you want to leave behind. So if you're currently taking only your RMD, don't panic. You may be doing exactly what makes sense for you, but don't let the number become automatic. Ask yourself, what do I need to spend? What taxes will this withdrawal create? Which account should the money come from? And what does this decision mean for the next 5, 10, or 20 years? Those questions can turn an RMD from something you simply react to into something you actually plan around.
So, what can you actually do with this information? Don't start by changing your withdrawal amount. Start by understanding where you stand. Step 1. Find your current RMD. If you're already subject to RMD rules, check your retirement account balance from the previous December 31st and use the IRS rules and applicable life expectancy table to determine the required amount. Your IRA provider may calculate the RMD for you, but don't assume the number automatically represents what you should spend. It's simply the amount you generally must distribute to satisfy the rule. Step 2. Calculate what you actually need. Write down your expected annual retirement expenses. Then list your reliable income sources, such as Social Security, pensions, or annuity income. Now compare the 2 numbers. If your reliable income already covers your lifestyle, you may not need large additional withdrawals. If there's a significant gap, your RMD may be only part of the money you need. That distinction is critical. Step 3. Look at every account together. Don't look at your IRA in isolation. Look at your traditional retirement accounts, Roth accounts, taxable investments, cash, and other retirement income. You may discover that you have far more flexibility than you thought. And if you have a spouse, look at the household picture, not just one account. Step 4. Look at the tax consequences before taking extra money. If you need more than your RMD, don't simply transfer a large amount and worry about the tax bill later. Estimate the additional taxable income first. For a meaningful withdrawal, consider speaking with a qualified tax professional or financial planner who can model the consequences before you make the decision. That's especially important if you're considering Roth conversions or unusually large withdrawals. Step 5. Don't let fear make your retirement smaller. This may be the most important lesson of the entire video. Saving money is a good habit, but retirement isn't supposed to be an endless continuation of accumulation. At some point, your money needs to move from being something you're protecting to something you're intentionally using. That doesn't mean spending recklessly. It means spending with a plan. If you saved $1 million for retirement, the goal isn't necessarily to die with exactly $1 million. The goal is to use that money to support the life you wanted while protecting yourself against the risks you may face later. And if leaving money to your children or other heirs is important to you, include that in the plan too. Don't accidentally create a strategy where you sacrifice your entire retirement just to maximize an inheritance. Your legacy should be part of your retirement plan, not the reason you never enjoy your retirement. And remember, inherited retirement accounts have their own rules. For many non-spouse beneficiaries, the Secure Act generally introduced a 10-year rule. but the exact distribution requirements can depend on the beneficiary's relationship to the original owner and other circumstances. So don't assume every beneficiary can simply wait 10 years and then take the entire account at the end. The rules can be more complicated than that. Now let's bring everything together. The headline says 84% of retirees get this wrong, but I would frame the lesson differently. Taking only your RMD isn't automatically wrong. Taking more isn't automatically right. The real mistake is letting the RMD number make your retirement decisions for you. Your retirement plan should answer 4 basic questions. How much do I need? How much can I safely spend? How can I manage my taxes? And what do I want my money to accomplish? If you can answer those questions, your RMD becomes much easier to understand. So here's your action step for today. Take 30 minutes. Write down your retirement accounts. Write down your expected annual spending. Write down your Social Security and other reliable income. Then compare your income needs with your available resources. If the numbers don't make sense, don't guess. Get professional advice before making a major withdrawal or Roth conversion. And if your numbers do make sense, that's valuable too, because now you're not simply following an IRS requirement, you're using your retirement money intentionally. That's the real lesson. You didn't spend decades saving just to build the biggest possible account balance. You saved so your money could give you choices. Use those choices wisely.
That's it for today's video. If you enjoyed it, don't forget to like, comment, and subscribe. See you in the next Smart Money video.